If I was an eCom owner in 2021, I would 100% not sell any of my assets right now. Instead, learn to utilize the correct tax deductions and the magic of depreciation to make sure Biden's tax law doesn't affect me at all. Here's how. Hey guys, this is Alan Chen with the Free Cash Flow Agency, and I'm a certified public accountant. First of all, thank you for tuning in to this video. In this video, I want to summarize the often confusing state of changing tax laws, which happens frequently when we have a new president in office, especially of the opposing political party, like what just happened in 2020. Just like when Trump introduced the Tax Cut and Jobs Act in 2017, which was considered one of the largest tax reforms in the last 3 decades. Biden is looking to make some sweeping changes of his own in his first 100 days in office. The overall goal of his tax code changes is to raise as much as $2.5 trillion over 15 years to help fund the infrastructure plans he has for American roads, bridges, water pipes, and other public structures. Perhaps one of the most impactful changes that President Biden is looking to implement is what is called the doubling. The doubling, as it was revealed in his plan, is to nearly double the taxes on capital gain rates from 23.8% to nearly 43.4% for the top earners in this country. This will be something that has never been seen before, as historically, capital gain rates has always been lower than ordinary income tax rates. To summarize what is capital gains, it is basically the tax you pay for selling investment assets that has increased in value over time. Some example of what that be would be stocks, bonds, real estate, artwork, antiques, jewelry, and soon to be maybe even cryptocurrency, but we'll see how that goes. Currently, this is the chart for long-term capital gains, which is any asset that you have held longer for a year and decided to sell. As you can see from the chart, the top rate for those earning over $488K in 2019 is 20%, but effectively 23.8%, as you are subject to another 3.8% Medicare surtax when you have crossed that high income threshold, otherwise known as Obamacare. Biden's proposed tax hike will make it so that if you make more than $1 million a year in taxable income, it will get it to the point that it will be at 39.6%. Then you add in another 3.8% investment surtax on higher income investors, and you're looking at an overall tax rate of 43.4%. Sounds like a huge deal, right? For people that have capital gains in the forms of stocks, bonds, other kind of investments they're currently in, especially real estate. But just remember this important point, right? You don't get taxed unless you go ahead and sell that asset. So for all eCom owners out there who are in the 7 to 8 figure range, who have learned to diversify their holdings, right? So then all their money is not made just through their Shopify or Amazon FBA business. It's important to note that you guys are perfectly fine if you can hold on to your assets during the implementation of the new tax law. So it doesn't affect you immediately, but it is something to think about and something you need to plan around if you do plan on, selling off your appreciated asset at this point in time, especially if these tax laws do get implemented and passed through Congress. The next change that Biden will introduce is he will increase the federal corporate tax rate from 21 to 28%. So under Trump's Jobs Act and tax cut that he introduced in 2017, he lowered the corporate tax rate from a high of 35% all the way down to 21%, which is a historic low for corporations. It was very celebrated, I'm sure, for big companies like Amazon, Facebook, and the likes. Now, Biden felt like this was too much of a benefit for big corporations, right? So he has decided that this rate should actually go up to 28%. Now, is this going to be the actual number that's going to have going forward? We don't know. The Senate right now is pretty split, I think 50-50. So he will need to have basically support of every single Democrat that this is a good change for America, this is a good change for corporations to tax them another 7%. I can see it actually being 25% with some compromise number like that. But essentially, this will only affect eCom owners out there if you're right now structured as a C Corp. Because if you're a sole proprietorship, if you're an LLC, or if you are a partnership, what you have is a corporate structure that's known as a pass-through entity. And what does pass-through entity means? It means that the income that you make from your business actually flows directly through to your personal income tax situation. on a, well, LLC would be a Schedule C. Same for sole proprietorship. Partnership has their own IRS forms. But what essentially happens is, because it's pass-through entity, you don't get taxed at the corporate tax rate. You just have to worry about your personal tax rate. So this change actually doesn't affect you unless you have a C Corp. So this actually makes it a little bit more of a disadvantage for you to go from LLC to C Corp, and more for you to think about, when you do analysis of the tax rates and whether it's worth it for you to switch at that point. And there's a lot of tax planning you can do around that. So with this change, corporations such as Amazon, Apple, and Facebook have historically got away from paying little or no tax, but have utilized every trick in the book, right? But under Biden's new proposed plan, he will also eliminate this loophole by imposing a 15% tax on the profits they report to investors. It will be limited to companies earning $2 billion or more per year, and this will be what they call a minimum tax. So companies aren't going to be able to hide their income, in places like the Cayman Islands or Bermuda or other tax havens out there, as Biden kind of said on his remarks to the White House that, he defended the tax increase as necessary to pay for infrastructure investments that America needs and to help reduce the federal deficit over the long term. So as you can see, this is really just a tax to make sure that the playing field is level for everyone involved, right? Because historically, big corporations like that, who you expect to pay the most tax, have been able to do really crazily smart tax planning, always playing the gray area of the IRS tax code to really pay no money to the federal government. And these are billion-dollar companies. So Biden's change would say, hey, I don't care how you want to use the tax code to your advantage, we're going to make you pay something. And the something is this minimum tax that he's going to implement to make sure that all these corporations will help fund his infrastructure plan going into the next 5 to 10 years. Of course, all these changes will need the approval of Congress, including increasing the corporate tax rate. Like I mentioned, given Democrats' very narrow majorities in the Senate and the House, that proposed rate could definitely change, and all these things can change, but it is something for you to stay ahead of the game of when they do get implemented, as there's even a chance that these things can be retroactive, right, to the beginning of the year. Another change in Biden's tax law is, under current laws, companies with headquarters in low tax rate countries, right, can move some of their profits earned by subsidiaries in the United States and send them back to headquarters as payment for things like the use of intellectual property, then deduct those payments from their American income tax. So the Biden tax law would close this loophole. This allowed those deductions for companies based in low tax countries. So that's kind of crazy if you think about it, as that has always been a way that companies have been able to get away with not paying as much taxes because they claim to have headquarters in these countries, and therefore they have always been moving any kind of income earned on the U.S. entity side to these offshore, Bermuda or, some like Malta headquarters, right? So this will prevent that from happening if this tax law get implemented. So it's something that you have to think about if you have been working on your multiple entity structure for your company and you have been taking advantage of being able to offshore a lot of this income. So this will close that loop. Another big change, then this has to do with the inheritance tax and when you do retire and how estate tax plays out. So under current laws, capital gains taxes are only applied to inherited assets, right, such as land, building, and stocks when they are sold, and then they are taxed according to what they call a step-up basis. So it's the value at the time of the descendant's death, not the value at which the descendant originally acquired the capital asset with property. So the summary of the president's plan says he wants to eliminate that loophole that allows the wealthiest Americans to entirely escape taxes on their wealth by just passing it down to their descendants, right? So basically he finds that to be very income unequal, and the president plans to close the loophole by ending the practice of stepping up the basis, right? Stepping up what the value of the asset is at the time that you're selling it. And he's saying you have to actually go back and say, what was the original purchase price of the asset? And you're gonna get taxed the difference now, which is a huge deal. It is basically for people that makes more than $1 million or $2.5 million per couple when combining it with existing real estate exemptions, and making sure that the gains are taxed. The property is not donated to charity. So something that you should watch out for if you are at the age where you're thinking of passing down your hard-earned money to your descendants, as that will be a huge change. So another change that I'm not sure we touch up on right now is corporate tax rate increasing from 21 to 28%. But there is also an individual tax rate increase from 37 to 39.6%. And this will only affect the highest tax bracket. So I would say if you do not make right now over 400,000, this is nothing for you to worry about, as this is the height of its effect. But I know there are eCom owners out there who are making that level of money, right? And I would say for you guys out there, I'm going to summarize at the end of the video for you. Just don't worry too much about it, as there are ways to work around making the income that's hitting the highest tax brackets. And we here at Free Cashflow are part of the solution that's helping you make sure that these new tax implications won't hit you very hard. So with all these proposed changes, there are several steps that eCom owners can take to protect themselves, which I will list here below. With the corporate tax rate hike to 28%, it may be more advantageous for eCom owners to stay with an LLC structure as long as reasonably possible under the regulations, right? As Biden is seen to be shifting a lot of the tax benefits from corporations back to individuals. But no matter what happens, learning how to take advantage of deductions and credits will still be the utmost beneficial thing for you to learn to maximize your tax savings in these areas, right? And with the capital tax rate changes, if you're making more than $1 million a year, it may be beneficial for you to either sell now if you really need the cash flow, or not sell and just keep holding, right? Like I mentioned, this only affects you if you sell your capital assets. It does not affect you at all if you just keep your assets, right? You keep your real estate, you keep your stocks and bonds, and let them keep growing, as presidents last 4 to 8 years, right? If they do 1 term or 2 term, there's always constant changes, right? In 4 years or in 8 years, we may have a Republican president again that may repeal all these things that Biden is putting in place or lower them. So by making sure that you take advantage of the current tax laws and the current news, all you have to do is hold on to those assets a little bit longer and take advantage of deductions. For example, if you own real estate and you're also renting out the property and making it a rental income, there's a lot of deductions in those fields where you can deduct your mortgage interest, your property taxes, and of course your depreciation on that building or that property, to make sure that that rental income doesn't get taxed very high while you're still earning rental income to support your lifestyle or your business. And the thing is, as long as you can just keep up with the rental income that at least breaks even with your expenses that you pay to upkeep rental property, then there's nothing for you to worry about. You could just keep holding on to it to get through these Biden tax law years. And the whole doubling of the capital tax rate does not affect you at all. Same thing with the stock and bond side, right? If you just hold on to the stocks and bonds that you currently have and really think like a long-term investor, then also this doubling of the capital tax rate for the time being does not affect you. So just keep holding, do not sell through this period. Also, another thing to mention, the lifetime exchange, right? The lifetime exchange is a method that may be even more, I would say, effective now that we know that this doubling of the capital tax gain rate might be happening soon. What the lifetime exchange does is it's a tax law, which Biden hasn't talked about, that he's looking to eliminate, where you can exchange one capital gain asset, right, say a real estate, for another one directly, where you as an individual do not have any cash change hands. So if you can imagine, you have a 2-bedroom apartment that's valued at $500K and you have it in New York, and you want to acquire a 2-bedroom apartment in Florida because your business is changing, or you just think it's a better investment to be in Florida. What you can do is go do this lifetime exchange process. Is you put up your 2-bedroom apartment, do an intermediary that takes care of all the cash, and basically they sell it for you, and then they use the cash to acquire that 2-bedroom apartment in Florida. And then for you, since no cash changes hand at all, you don't get subject to the capital gain rate at all. And then they buy that 2-bedroom apartment in Florida for you, and then you acquire the property. No cash changes hand if the value stays even, or stays the same. And then you just get this new property, and you end up not paying any taxes on the 2-bedroom apartment that you sell, because you're getting a similar or a like-kind property in exchange for what you're selling for. So it's a very powerful, a little bit complex method, and something you should look into if this is something that you want to do, and something where you're looking to sell your property for any reason at all, where you don't be subject to the taxes, right? Especially if this has always been a rental property, so you're not able to take advantage of the real estate exemption if you are living in that property for 2 out of 5 years. So something for you to look into. So another thing to mention that, foreign companies are looking like they're gonna be a little bit more attractive than having a US company at this time, right? So for the foreign eCom owners out there, if all of these things get implemented, it may be a reason for you to stay a foreign company, right? I mean, there are legitimate great benefits of having a US company, right? Like having the access to the US credit card, which gives great point system for like ad spend and office supplies and things like that. And of course, you get access to US bank account, especially if a lot of your customers are in the US side. You don't get subject to the harsh transfer pricing or exchange rate that happens by exchanging those sales back to your home country's currency. If a lot of these things get implemented, the tax rate is gonna look higher and higher, and they're limiting the loophole where you can, transfer a lot of those, I would say, intellectual properties and other ways to your foreign LLC headquarters. So there's something for you to think about, but it doesn't mean that you shouldn't have a US LLC at all. It just means that you have to think more carefully what part of your business you're gonna put to your US LLC side. And then the planning you do around there will just make sure you protect yourself even more so you're not subject to taxes that you didn't know that was gonna happen. Real legitimate reasons why a corporation should not be required to pay corporate income taxes in a particular years, such as deduction for accelerated depreciation, R&D tax credits, and net operating loss carryforwards. And that's something that you guys should really look into so that you're not afraid of the new tax rates coming down. There are a lot of deductions and credits available to you guys, even under the new Biden tax laws. They really haven't gotten rid of ways for you to, get your taxable income as low as possible. So just rest assured that if you are talking to a certified professional that is very understanding of how your business is set up, you still have nothing to worry about. So with that said, I hope this was a good summary of all the things that Biden's tax law is looking to implement and looking to propose, and how it's going to affect eCom owners in 2021 and going forward. As you can see, some of these things are going to affect the higher eCom owners out there, but there's still a lot of ways for you to not have to pay as much taxes as you think, right? And that's kind of what we do here at Free Cash Flow. We help our clients to make sure that under every single deduction possible, under every single tax law change possible, there are the ways to take advantage of them and how to set up your company so that you are not going to be the person who are going to be paying more money than you're supposed to these guys. So I hope this video was very beneficial for you guys out there. I hope you guys were able to learn a lot from this video. And if you do have a burning tax question, please feel free to leave a comment below and we'll try to answer to our best of our abilities. And if you are eCom owners that have more complicated situation, or if you are worried about the new tax change, feel free to set up a consultation call with us at Free Cash Flow Agency. We would love to help you alleviate some of these concerns and possibly work with you if you are a good fit. And if you're just starting out as an eCom owner and you're looking to really understand about IRS tax terms and any kind of business strategies that you can use as your business starts to grow and scale, we highly recommend our tax-free eCom Hyperdrive, your after-tax profit course, which we spend 3 months to really put in all industry knowledge in to make sure that you are taken care of every step that you grow. We'll put all the links below that we think will be relevant to you. Thank you again so much for tuning in and listening to this video. If there's anything else that we can do for you, feel free to let us know. We're happy here to help. And if you enjoyed some of the content of this video and was beneficial for you, please give us a like, subscribe, so it motivates us to put out more of these videos for you guys. Thank you again so much, and have a great day out there. Peace.